Hello and welcome to IIFL Markets. Today, we are joined by Abhay Laijawala, Managing Director and Fund Manager at Avendus Capital Public Markets Alternative Strategies. He's an expert on India's capital markets and has covered over 120 stocks across different sectors. He's also one of the pioneers of ESG investing in India. Avendus India ESG Fund is the first ESG fund in India. Welcome, Abhay, and thanks for joining us today.
Thank you for having me.
Yeah, so let me start with, the overall approach that you think retail investors should take in current markets. What is your view on the markets right now?
So I think overall, the view on the markets continues to remain supportive. But as is always the case, you have to keep an eye on what could potentially go wrong. And I think given that this entire market move has been seeded since last year by global liquidity, we have to keep one eye on global liquidity and as a corollary on what the global central bankers are going to do. So with inflation moving up, there is a lot of concern that the Fed may be behind the curve. Now, whether that is the case or not, time will tell. At this point in time, the Fed has said that the big jump in inflation on account of the stimulus-led demand shock and constrained supply chains could be transitory. And logically, that does make a lot of sense because as a result of what's happened on account of the pandemic, we have seen supply chains get impacted, and even demand, which was very soft, has suddenly come in, aided by the massive increase in the stimulus checks. So this is something that we will have to watch moving forward. So this is something that investors will have to also watch moving forward. The second thing that we will have to be investors will have to keep an eye on is earnings growth in India. Because expectation is that in FY22, we are going to see very strong earnings growth. But at the same time, the last few months, we have seen the rising cases for COVID and the collateral economic damage that will take place. So as long as this collateral damage on account of COVID going to be restricted to just the June quarter, and we do not have anything that impacts earnings growth in the rest of the year, it should be fine. But if there is anything that leads one to believe that we are going to have a third wave and we are going to have a recurring thing over here, then again, that will be a risk factor. So I think those are the two things. Overall supportive on the markets, but at the same time, keeping a close eye on global liquidity, i.e. what the central bankers will do, and the second one on COVID cases in India.
Absolutely. Now we move to ESG investing, which is something that you've been amongst the early investors in India to really focus on that theme. Now, we understand that it is relatively nascent in India while it is still gathering momentum around the world. But we have seen that in the post-pandemic, there has been increased emphasis on ESG investing. So do you think it is here to stay? Because there are still investors who still believe that this is more of a short-term trend or a fad, so to speak.
No, in fact, nothing could be further from what you mentioned. It is not transitory. In fact, ESG is going mainstream. And we think that, within 2 to 3 years, everything will be ESG. Almost every fund will be looking at the ESG style of investing. Yes, in the last few years, we have seen ESG being pushed by or being demanded by investors who were looking at socially responsible investing. It is now becoming a way to generate alpha. So in that sense, it is becoming self-fulfilling because it is becoming a source of alpha generation. So we remain very confident that, in the world, ESG has already gone mainstream, particularly in Europe, somewhat in the United States, increasing in Asia. And we think that in a few years, it will be going mainstream in India as well.
What role do you think, regulators and industry bodies have to play in, making this reach further?
Very good question. Regulators will have played a critical role, and they will be expected to play an even more critical role moving forward. Because up until now, the ESG disclosures have been voluntary. There are no, mandatory guidelines on what constitutes ESG. There are no ESG standards. So you had companies disclose, you had these global ESG ranking providers come in, but rankings kind of differ from provider to provider. And therefore, the investor does not necessarily know, what he's really investing in. In addition, a lot of ESG, a lot of mainstream funds, normal equity funds internationally are being repurposed as ESG funds because investors want to invest only in ESG. So there is no clear-cut definition as to how do you define an ESG fund. So given that the whole ESG movement has reached a critical inflection point, the regulator will need to enter over here. So in Europe, there's already been a lot of regulation. You had Europe come up with its taxonomy, which pretty much sets a framework of what constitutes ESG and on climate change. And Europe recently announced the SPDR rules, which stipulate that every mutual fund that calls itself an ESG fund has to define as to why it's calling itself an ESG fund. So these are the moves that are going to take place. You will see a lot of action. So far, the regulatory action has been led by Europe, but we now believe that with the Biden administration being sworn in the United States, the US Securities and Exchange Commission is going to come out with a lot of regulation, starting with very stringent disclosures by corporates. And I think the rest of the regulators around the world will follow. Look at India as well. SEBI has come out with the BRSR guidelines, which are reasonably detailed, and I think they're going to be very, very helpful for ESG investors because it will allow the ESG fund managers to have far more data in a more standardized manner across the coverage universe.
Yeah, so like top 1,000 companies. Yeah, top 1,000 companies have to do that. And, as I understand, this BRSR norms are on as per GRI guidelines. So I think that also allows a little bit of blending of.
Yes, it is under the GR. So they're completely international in that sense. Yes.
Yeah. Okay. So I now want to move specifically, towards your ESG fund and, want to understand the approach that you follow while taking investment decisions, while investing through your funds.
Sure. So, when we started the ESG fund 2 years ago, we were very new to ESG in India. So it's been a massive learning process. And I must say that in the 2 years since we've, started this, we think that we've come a long way. So our approach to ESG is fundamental. And we believe that to really get the true benefits of ESG, and there are two objectives of an ESG fund. One is creation of alpha, and the second one is investing in responsible companies. And one and both merge into the other, because if you invest in a sustainable company, then that it itself becomes a source of alpha generation. So with those two objectives in mind, our ESG process starts at the country level. Because remember, for you to get the true benefits of ESG and really achieve what you set out to do by launching an ESG fund and an investor coming into an ESG fund, you have to have or define the materiality of ESG factors. And for us, therefore, the materiality starts at the country level. So first we define 3 or 4, we have, I think, 5 core country level ESG issues, which we will focus on. They are air pollution, they are water insecurity, they are cyber security. We look at the carbon footprint and therefore climate change. And we look at minority shareholder rights. So with these broad country level ESG factors, we then drill down into our investment process. So based on the country level factors where climate vulnerability, air pollution, etc., are identified ESG factors, we say no to any investments in fossil fuels in our ESG fund. So no coal, no oil, no gas, no thermal power equipment producer, no coal miner, no thermal coal power, no thermal coal power based utility, which means no NTPC, no Coal India, no BHEL. In addition, we will also not invest in tobacco. We will not invest in alcohol. We will not invest in weapons. So these become the exclusions. After having done this, our work starts, because now we come and we integrate ESG factors into our fundamental analysis. So we will integrate a whole host of ESG factors. And we could be looking at, I can't talk about everything because we are looking at probably 200 variables that we will be looking at. Of course, certain variables we'll be looking at in far more depth. But overall, if I'm not mistaken, we have something like 200 variables that we will look at. And we will integrate these ESG variables with our fundamental analysis. So we will integrate the ESG factors to look out for ESG risks and ESG opportunities at the profit and loss, at the income statement level. Of course, there are certain factors which are far more relevant for banks, whereas there are certain factors which are far more relevant for an FMCG company. So for example, for a bank, we will be looking at things like product safety, things like cyber security, things like how is a bank lending, what are the sectors it's lending out to. But for an FMCG company, we will be looking at the water footprint, plastics management. Is the company using plastics? If it is using plastics, is it using single-use plastic? Is it reusable plastics? What is the extent of recycling? Does the company have any commitment to reducing its water usage? So what we ask companies is, do you have a plan on how much water you use per capita of production? And do you have a strategy on what the goal is to be in 3 years from now, 5 years from now? And we then go into the details as to if it's an FMCG company. We ask them, do you have any products which you come up with for a country like India, which use less water? So for example, there is an FMCG company, it's a multinational, and they've done a lot of R&D and come up with a detergent in India that actually uses less water at the rinsing stage, because most of the water in a detergent tends to be used at the rinsing stage. So this company, it's a global multinational, no guesses, I'm sure you probably know, and your investors will also understand which company it is. That company, has actually developed a detergent for use in water scarce countries. So, these are the many variables. And, we believe that ultimately, while all these look very abstract, when you put them all together, they become sources of value creation. So, that's how we think that ESG adds value. It allows you to look at opportunities, and it also allows you to see the risks that fundamental analysis may not have been able to fully capture.
So I've looked at the ESG fund, and there are like around 20-25 companies. Now, is that a function of, is that the size that you want it to be, or is it also a function of how the ESG practices are incorporated by India Inc.? Do you see there is significant scope? I mean, how would you rate their ESG practices generally? What has been your observation?
Sorry, I didn't understand the question. Could you say that again, please?
Yeah, so I mean that if you look at the ESG practices of India Inc., what are your observations? Do you think they are still at a very early stage, pushed by some compulsion or the other, or do you think they are really doing a lot on that front? And I'm talking across the board, large cap, mid cap.
Yeah, see, it is not. I don't think it's very appropriate for me to discuss the ESG practices of the other funds, because each one is having an approach, and each one is having their own methodology. So I really would not. It's not appropriate for me to talk about the others. What I will say is that at our end, we are using integrated ESG, and we go far beyond the ESG rankings. So rankings form a very, very small component of our whole ESG investment process. And we do our own ESG analysis. As I said, we integrate the ESG factors, and then we come up with our stock selection. In addition, I think what an ESG fund must do, and here I can say this, we are the only fund doing it, is because of the climate vulnerabilities of India, it is imperative for an ESG fund to disclose the carbon footprint of its portfolio. Because it's an ESG fund. It's an ESG fund in a climate vulnerable country. So climate risks become core investment risks. And these investment risks are therefore captured through the carbon footprint of the portfolio. Ideally, the carbon footprint of an ESG fund in a climate vulnerable country should be lower than the carbon footprint of the corresponding index. So at our fund, we have decided that our carbon footprint, that is the carbon footprint of our ESG fund, will always be lower than the carbon footprint of the Nifty index. So this is something that I think all funds should do. They should be disclosing the carbon footprint, because an investor in an ESG fund has the right to know what is he investing.
Yes.
So these are things that I think we need to bring out, and not just invest on the back of what an MSCI or a Sustainalytics say in terms of what is a good ESG company or a bad ESG company. So these are some thoughts that I have, and I think therefore the process really needs to evolve in India, and we need far more transparency on the ESG parameters of that fund, and not just the fundamental parameters. An ESG fund has to differentiate itself on the ESG factors, in addition to, of course, the fundamentals.
So I want to understand in terms of, the companies or the sectors which you think, stand out when you put together all those criteria that you have. What does your analysis really tell us there?
So, by virtue of the carbon risk, carbon or any companies that are large, generators of carbon emissions are anathema, if I may use the word, to an ESG fund. So an ESG fund, therefore, will not have or will have an underweight, either not have at all or have an underweight, depending on the investment style of the fund, to all the carbon intensive sectors. And when I talk of carbon intensive sectors, I mean everything ranging from oil and gas to cement and even steel, because steel, cement, and in India, aluminum as well, because aluminum in India is produced, primarily or not primarily, only through thermal coal, which fires the captive power plants of the aluminum companies. So that is a highly carbon intensive process, as we know, because it's a coal-based power plant that provides captive power, which an aluminum company needs. So you asked in terms of sectors. Most of the sectors that are carbon consumers will either be excluded or will be underweighted in an ESG fund. So generally, ESG funds tend to be reasonably high in terms of weightage towards banks, towards technology companies. In India, it would be the IT companies. You can have automobiles in ESG, but in automobiles also you have to be careful, because what kind of a fuel is that automobile company reliant on? Is it diesel? Is it petrol? Because until electric vehicles come in, you have to invest on the back of whether it's petrol or whether it's diesel. And there are far more risks that we see for solely diesel fueled automobile companies. And in a country like India, that is reasonably high risk because of the high levels of pollution in all our key cities. And we see a very high risk of government penalties on diesel cars as the citizenry becomes more and more aware of pollution and starts demanding pollution control from the politicians. Look at what's happening in China. The Chinese government is becoming extremely pollution wary. And I think it's a matter of time before India, does similar things. So these are the sectors. ESG funds will tend to be underweight carbon and overweight perhaps banks, perhaps technology companies, and maybe automobiles, particularly with those that are petrol and have a very credible roadmap on electric vehicles. And when I say credible roadmap, it isn't just a blanket statement saying, we intend to be an electric vehicle manufacturer in the next 4 years. What we'd really like to see is, how do you intend to be that? For example, Volkswagen recently, really impressed investors a month ago when they gave out a very credible strategy on their electric vehicle footprint, including saying that we are setting up 3 giga battery plants in Europe and investing in them, and gave the details on what these investment plans were. So, that's the kind of stuff we'd like to see.
Mm-hmm. So in India also, we've seen the likes of Mahindra and other companies also talking about EVs and, having plans in place. So what are your picks there, across the board, if you see?
I think I won't talk about stocks, because I don't think, in the media we talk about stocks. We can talk about sectors. I'll avoid talking about stocks.
Okay. So, let me understand in terms of when you look at retail investors, for a lot of them, ESG investing is very new concept and it becomes a little technical, especially on the environment front. So how would you suggest them to approach identifying stocks based on this criteria, involving ESG criteria in their investment decisions?
So, here I'd like to say that perhaps because ESG is very specialized and it requires at this point in time a lot of information, it will be very difficult for a retail investor to, go into that kind of a depth, because as I said, we analyze 200 variables, right, for companies, and it becomes very difficult for a retail investor because because so far the ESG information is not as readily available. ESG rankings, ESG variables are not readily available. So I think the best strategy for a retail investor would be to come in through an ESG fund rather than do the ESG analysis by themselves. For the simple reason that the data is either not available or the data is just so widespread that I think it would be very difficult for a retail investor to do all of that or to even get the data, because a lot of that is paid data, which is not available in the public domain.
Right.
So the cost and the ability to do ESG analysis right now gets restricted, and therefore it's best to come in through an ESG fund.
Okay, so I also want to understand, we've seen usually in India, a lot of ESG funds are focusing mostly on the large caps. It has not really gone down to the mid caps and the smaller players, though some of the names have reasonably credible ESG practices. What is the reason for that, and how do you think that will change?
The reason for that is very clear, that there was no data available beyond the top 100 companies up until now. But with SEBI encouraging more and more companies to release, earlier it was BRR, so I'm talking based on BRR, more and more companies to disclose their BRR, disclosure levels are now available. So my sense is that now onwards, with disclosure levels available, and more credibility to these disclosures, because look, there's a lot of greenwashing that happens, and many companies realize that an ESG disclosure or very fancy sustainability reports give you, higher rankings or higher valuations. There is a lot of greenwashing that happens. So therefore, for an ESG fund and for all of us fund managers, we really need to do a lot more work on the smaller companies. So up until now, that comfort was not there. But my sense now, looking at the disclosures that are coming out and our own understanding of ESG, because we've all learned in the last 2 years, we are able to now tell very clearly if a company is doing greenwashing. 2 years when we did not have the expertise, we could not have done it. So which is why we started with the large cap funds. And I think moving forward with the disclosures coming through and with the fund managers' ability to sift through these disclosures, we will see a lot more mid-cap coverage come in the ESG space. So we will be looking down the cap curve as we get more and more comfortable. We may not be able to go down to the 400th company in terms of market cap, but can we go to 200? Can we go to 250? Yes, we can.
Sure. So in terms of your own profile, your own investment portfolio, what are the downside risks that you foresee, going forward, which could really, change the equation of investing?
Downside risks from
those companies,
yes.
Yeah. From an ESG perspective, general investment perspective.
So I think what I would be concerned about is fast-paced regulation on carbon pricing. But because we don't have any carbon, we will not be impacted by that because we don't have any carbon in the portfolio. But I think that that's a big risk. That what if the world gets together and announces a carbon price on carbon emitters like you have in Europe? What if it's announced in the US? And then, what if US and Europe say that we will not allow any imports from any country unless and until the companies there are paying a carbon tax, or that the product gets taxed at our level. So these would be risks because these companies will not be able to then handle it, and you could see a very fast-paced erosion in the valuation. For example, on aluminum, what if the world says that LME says that we want to trade green aluminum? Then there will be a very big difference between the price of green aluminum and gray aluminum or brown aluminum. So then what happens to a company which is not in green aluminum? What if there's a carbon tax of, so we've estimated, just to give you an illustration, that if the world imposes a $50 tax on carbon, then an Indian aluminum company would see its cost of production go up by $600 per ton. So from around $1,600, it could go to $2,200 per ton. So these are the risks that that investors would need to be aware of. From our side, because we don't have any carbon, that's precisely the reason why we don't have carbon, because as I said, carbon risk is becoming investment risk. We see relatively lower risks to our portfolio. But of course, risk is risk, and we are always looking out for risks. Maybe there are certain risks that we haven't considered which could come up, because that's part and parcel of managing money. Mm-hmm. As long as you manage to mitigate as much risk as possible, then you are doing a job. I don't think there's anyone who can say that we can manage the entire risk of the portfolio.
Mm-hmm. Any good books that you would like to, suggest to our to our viewers who can, on this topic of ESG investing, ESG in general, for retail investors, which they can read and probably understand more?
I can't think of any one specific book, because rather than books, I think there's a lot of literature that's available, and investors can look for articles written by George Serafin, who writes a lot on ESG, and something like that would be very, very useful. Unfortunately, there is no one book. There is a lot of literature out there. But unfortunately, there is no one book that I can really think of in terms of ESG, because it's still an evolving concept.
Right. Any parting thoughts that you would like to share?
Stay safe and be very aware of risks that you don't think of in your daily investing styles. And my parting advice is that up until now, financial markets have been impacted by financial events. So what I'm trying to say is that you had the global financial crisis, you had the Asian financial crisis, and those were systemic crises which roiled financial markets. But the pandemic was a physical event. It was not a financial event. And yet it had an even bigger impact on financial markets than financial events. So the thought that I would like to leave with investors is that be aware of the physical risks that could come in. And these risks could drive a massive erosion in your investment portfolio. So up until now, you had to be worried about financial risks. Now we have to worry about physical risks. And when I say physical risks, it could be health, it could be climate change, it could be anything. And therefore, I'm saying that please take into consideration ESG factors in your daily investment life. Otherwise, you will miss out on some of these risks that are going to recur more frequently than they have in the past.
Thank you so much, Abhay, for joining us and for sharing your insights. Stay tuned to IIFL Markets. Stay tuned to IIFL Markets for more of such interviews and updates. And subscribe to IIFL Markets YouTube channel. Thank you.